All right. Well, hey, good afternoon. This is Jay Hughes with Press On, and joining me today is Jim McMahan. And Jim, as most of you probably know, is the president and partner of Benchmark Mortgage in the Dallas, Texas area. Jim, he's had a very long and super successful career. He continues to be one of the most recognized leaders in the mortgage lending industry. And I would say this, about you, Jim. Jim is not what I would call an ivory tower leader. He doesn't just sit up, perch from above. He's definitely one. He's been in the trenches. I think, Jim, you still, to a degree, work in the trenches. You understand loan officers and even real estate agents and the difficulties that go along with those professions, the opportunities as well. Jim closed over 5,000 transactions, nearing about $1.5 billion in loan volume in his career. The last 10 years, he has been serving Benchmark Mortgage and its customers, first as an executive vice president and national sales trainer, and now president and partner. And Jim, you've helped kind of craft the vision that's going to carry Benchmark into this second decade of the century, and helping Benchmark to be recognized as what it is, one of the industry's best. Jim is well known in our industry, though, not just for his production or leadership, but as a speaker as well. Jim has taught live to originators, real estate agents for over 20 years. And I think, Jim, if I remember correctly, I think the first time you and I met face to face was at an event where you were speaking to 150, 200 realtors. And Jim, his reputation precedes him as a speaker and motivator because he has the ability to help professionals just like you, those of you that are listening, to grow their businesses, especially in tough markets. And so, Jim, welcome. Thanks again for being with me today.
Thanks, Jay. Man, that's awesome. I mean, I appreciate that. I'm not that good, but I've done some of that stuff, and I really appreciate it. In all the years we've known each other, too. Time does fly, and I appreciate that because I really want to share today just on some of the topics we've planned for. Because of that experience, I started in late 1986. It's hard to believe, 32 years ago or whatever that is, 32 or 33.
Crazy.
Yeah, and I've seen a lot of cycles, and this is a very unique one. And, because our industry, start off the thought process, is really just this series of 30-day cycles, right? And so, you look back at like 30 years in the business, I ask myself often enough, have I been in the mortgage business 1 year 30 times, or have I been progressing consistently over 30 years and trying to learn and grow and continue to make a difference? And hopefully it's the latter. But thanks for the time today. I look forward to this.
Yeah, absolutely. And with that, let's jump in. Speaking of cycles, we wanted to spend a little time today together discussing the mortgage and real estate markets in general. And specifically, I really wanted you to talk about this dynamic that's going on right now, that's making it tough, but also, as I know, everything that's tough provides an opportunity, but it's a tough business out there, tough to make money. And so we have compressed margins, we've got Fed tightening, the cost to produce a loan continues to grow. So just take a couple minutes or as much time as you want and talk to us a little bit about what you see, what's going on, and how those things are linking together, and what are mortgage companies and loan officers, what do they need to be aware of?
Okay, good. I like the question very much. Thank you. With all the different listeners you have, you're going to have people that I very respectfully say are old dogs in the business like us, which is the 20 years and longer folks, and then you've got a whole new generation of people that have been in the business. I mean, generation, even like go back 10 full years, that have literally never seen a Fed tightening cycle. Last November, I pulled our executive team, which has been together, all 6 of us for 10 years now, a few of them a little longer than that. And I said to everybody, I kicked this meeting off with, guess what? And all that we've done in the last 10 years together, there's one thing we have not experienced together. And they're all like, what? I said, we literally haven't had the Fed tighten, because most of us have been together since '08 and beyond. And, the Fed hadn't really tightened until last year. You got to jump back to late '07, early '08. And so it was like, wow, that's an interesting thought process because we're all old dogs in the industry, but had not gone through that cycle. And so we began to plan in November. And
aren't rates just supposed to go down all the time? I thought, that's
yeah, exactly. Well, I posted a deal to our loan officers a few weeks ago where I took, average interest rates of the 70s, average interest rates of the 80s, average interest rates of the 90s and the 2000s, and then currently today. And everybody, the response was like amazing because it's like, wow, that's still amazing that we're in such a low sector at 4 5/8 or 4 3/4, whatever we're at right now, even though we bounced up to the low fives there for a little while. So let's talk about that, because the big picture, where are we now and why? And there's a term that I used a lot in my speaking years, Jay. You probably heard me say it. And it was fiscal literacy. And I think that my big deal as an originator is I wanted to be known as being very fiscally literate. I use that term a lot. And I could sit down and show a client, and that was one of my big things of the why behind the marketplace, and why behind interest rates, and why they would move, and what was going on. And so that kind of went away for a while because, with rates, like you said, continually going down, and then they get a little wind gust up for a little while, and then they come back down again, from 2008 through the past few years. It was just a loan officer's dream. As long as you were competitive and could do things right, the integrous, you could do business. Today it's more complex, and the reason is we're back in a Fed tightening cycle, okay? And so when the Fed tightens, and my message to my leaders back in November was, there will be this phenomenon called margin compression. And it's this loose term used, but it's always been around, and it's the reality that when the Federal Reserve does tighten the cost of money or interest rates at the Federal Reserve level, that obviously sprinkles into everything to do with consumer lending and commercial lending in the United States, and can have a ripple effect even across the world. And so that's a big deal, right? It's a big frickin' deal. and so, I'm going to start the thought process right, because there's loan officers listening to this that are like, well, how does this affect me? Well, it affects you a lot, but you've got to understand the reality of what's happening. There's a lot of people that don't so much have you in mind, but it affects you and your consumer and the reality of all things mortgage lending. And so let's just talk about what Fed tightening cycle means and what's happening. You've got, in the lending world, obviously, there's brokers, there's mortgage bankers, which is what we are, that, have warehouse lines and have their own cash and lend and securitize. And then in the mortgage banking world, there's folks that are on mini correspondent lines that just have like a small funding platform. And there's some that have, hundreds of millions like we do, with lots of cash put up. We're Fannie Mae seller servicer, Freddie Mac seller servicer, Ginnie Mae seller servicer, service about $1 billion of our own, to people that are doing lots more than that, to some that are less. And then you got the banks, of course, from the big guys like the Wells and the Chases and the B of A's to the mid-size to the small. So the three main component of lenders out there, everybody's affected somewhat the same and somewhat differently. I'm going to start with our camp, the mortgage bankers, which there's a ton of. It's the majority of the lending industry today.
Yep.
And basically, when a mortgage banking operation gets hit with Fed tightening and margin compression, if you're not prepared, go Google latest mortgage news layoffs, and boom, look, I'm not going to name names today, but you can just name them all. I mean, Chicago-based company the other day laid off 188 people. One out in North Carolina laid off the third group of over 100 operations.
Without question.
It's everywhere. I'm proud to say we've laid off no one. We've actually hired several people. We're up 24% year to date, year over year in volume, but our margins, I'll be honest with you, are off about 20%. But we planned for that. It's okay. The branch we gave. But here's what's happening in margin compression. Like a mortgage banker, we're borrowing on a warehouse line. We've got that borrowing cost down somewhat in our P&L. Everyone should, but as rates rise, like this year, I looked it up this morning, our cost of funds to borrow is probably 155 to 160 basis points higher right now than it was at the first of last year, first of 2017, almost 175 basis points at some points. So that's a lot, right? I mean, of just your cost, your raw cost to borrow. And so where some mortgage bankers were out there every month actually making money on their float or making money on loans that they might have closed and then they either put into their own servicing portfolio, or many of them that have to sell everything service release because the majority of mortgage bankers do and don't have Fannie Mae direct seller servicer and all that. That part's gone. So that's the first part of margin compression is where you were maybe making a couple bucks, just extra dollars that you didn't even count on. You're either trying to hedge to break even every month, or you're actually losing a little bit in funding loans through warehouse lines. But the sprint there is to move your loans. Like we move our loans extremely fast. Probably the industry average is 20 some days. We move them in 11.4. But the bottom line is there's a cost there, right? So that cost is higher. And then the biggest part of margin compression that's just flat in the marketplace's face is, let's just say Jay Hughes is my customer, Jim McMahon's the loan officer, and Jay's dealing with Mary at Remax, and I'm referred, and you bought a house in the past 90 days, and your friend who bought last summer referred you to all of us. That friend, multiply this times a few million times around America, that friend got 3.75% to 4%, and at the highest maybe you got 4.25%. So you're coming to the marketplace in a margin compression. That first generation buyer, as margin compressed and the Fed tightens, still has a mindset of what it was. And
yeah,
so
I want my 3.75.
Exactly. And then, the loan officer is explaining, well, rates tighten, rates travel in a range, all the things. I used to teach fiscal literacy. So you can do that education. Then here comes the other side of it. Okay, I'm going to bring in the marketplace because there's a lot of smart people listening to this. So let's say that Jay Hughes did not become this amazing motivational trainer and life changer giver that you are, and you became a bond trader working for Goldman Sachs in their London-based office. Well, if you're managing a couple $1 billion portfolio, you're on a team managing the California Teachers Pension Fund and the Teachers Pension Fund and all these other places that have bonds, you don't care about Jim McMahan, the loan officer, and his well-being. When the Fed starts tightening and you're moving a portfolio and you're buying and selling hundreds of millions of dollars in bonds, and some of those are mortgage-backed securities, which are a pretty good investment because they're consistent over time for big funds. When the Fed tightens, you're not going to buy as an investment banker, Jay, the 3.5 or the 4% coupon anymore. The money's going to be in the 4.5 and the 5, and you're going to only go there, and because you're buying out over time and need consistent returns. And so the shift in the margin compression is the biggest one, where lenders get crushed and all these changes and people playing off and people being bought out, quote unquote, and people selling servicing right and left right now at very discounted pricing to raise cash to fund operations. All those things that are happening in the industry, cutting loan officer comp, blah, 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 is because of the phenomenon I just said. There's less money in the 4 and the 4.5% coupon than on the mortgage-backed security than there was a year ago, because it's shifting up. That's that shift in the Fed tightening cycle that creates the compression behind, and that there's that first generation of folks that still want to try to get the low rate, and there's lenders that will actually try to give it, and then we all know the banks and the credit unions and different folks that will give it for a little while, but they are not. Like, there's loan officers out there making 125 basis points, or some making 150, there's some making 75, and then there's banks and credit unions that are paying people 40. And so, that's a huge difference, and something we need to weave into today's conversation is what I'm going to call the economies of a loan. My good friend Marty Preston did a really cool presentation the other day that he put together for his group on that, where he literally broke down. He took his office and he did some dialogue with our COO and looked at our company and came up with that, closing costs 11 basis points and underwriting costs 14 basis points. And then he did a presentation to his own loan officers and said, now, how much do you cost again? And his own people were like, well, I make 110, I make 125. And just the reality of the economics of a loan, and other people that are staying a little lower right now and paying their people less, or all the games that can get played in the industry. And even, banks, have always been able, when they get squeezed, they may pay their people less, they may keep rates a little lower for the high FICO score borrower or whatever, but then they know as rates go up, they're going to make more on car loans, they're going to make more. So there's a lot of ways people move through margin compression until things kind of shift and get steady again, which they're starting to stabilize now. We can talk about that too. But the really bad hit was late February, all of March, all of April, and into May, when the Fed basically came out as this Trump economy is becoming very, very real. And as you and I both know, last week, the GDP printed 4.1% in the second quarter, and again, people 2 years ago at election time said there's no way we'll see a 4% growth rate that quickly. Well, we just did, for real. And, the economy is doing great and things are good. And so there's a lot of phenomenons out there right now because as good as the economy is doing, inflation is still very steady. Wage inflation, which is the number one phenomenon to watch if you want to learn something out of this call from a fiscal literacy standpoint. When wage inflation comes, rates will rise. Right now, 30-year fixed are actually pretty cheap compared to the reality that the Fed has tightened 7 times now, I think, since last year. And today, while we're doing this call, this is a Fed day. They're not going to do anything today, I would tell you, but they're laying the hints that they're probably going to tighten again in September, at least one more time this year, and maybe 2 times next year. And so, again, jump back to election day 2016, fixed rates are still mid to high 3s, depending on FICO score and all that. And then, jump forward to today where we're a solid 100 basis points higher than that, and have been as much as 130 to 140 basis points higher than that. That's the reality of the shift in rates and the margin compression and the Fed tightening 6 or 7 times now. So all that to say, in that explanation, the compression piece is that combination of the true rising cost of funds with a mortgage banker or even banks and brokers, and then the reality too of the squeeze of the consumer wanting the lower, people playing in the game of giving the lower as they finally shift upwards. Okay, so stop there and breathe a minute. Questions in that, or
well, you think about too? I was just going to say real quick, Jim. Sorry to interrupt you, but you have the issue as well where with borrowers, maybe for sure lots of first-time home buyers out on the market during this time period where they pre-qualified and it's taken them 90 days, 120 days, several months to find a home because just the lack of inventory issue. So it's not just that people have knowledge that rates were lower, back, a year ago, but perhaps they've been pre-qualified at a rate and it's just taken them a really long time to identify a home to purchase.
Yep. Well, first off, that's a big, big deal that the loan officer needs to be educating that buyer. And this is the opportunity where people panic or think it's so hard right now. I mean, I know people in our company and others that are having their best years, their best months, their best quarters. I just had 41 of my best salespeople in town for 2 days last week, and we did this really cool, 2-day kind of brainstorming mastermind on how to do better and just share best practices and some great stories, because in the chaos of these moments and these times comes the greatest opportunity to get back to what? Advice. The key word is be a mortgage advisor, be a true trusted advisor that you're breaking the egg on. It's not just about rate and fees, as we know, but educating the buyer that there is 20-some things that actually affect rate and fees and overall costs and total cost of the loan. And so, let's really look at all the things that are most important about this loan to you, Mr. and Mrs. Smith, and then let's understand that, you still have that car loan with a $300 payment, and you've got enough to put 10 or 15% down. Well, maybe we look at a lender paid MI because your FICO score is 740, and you can keep that money and pay that off and have that payment go away and then apply the difference. And let's get back to that kind of great advice, because always in my career, go ahead.
Well, I was just going to say, no, I think that's dead on. I mean, one of the things I'm talking to my private clients about all the time, and when you and I are both out speaking, is how do you identify yourself as an expert, as a leader, how to separate yourself from your competitors, and you nailed it. It's an opportunity right now to do that, to educate yourself so that you're not an order taker. You are, like you said, giving advice and helping walk borrowers through this process, educating them. What a tremendous opportunity to separate yourself from competitors.
Yeah, it's huge. But the big if or but is, because life is conditional, how knowledgeable are you? It's really, really time to spend more time on you and making sure you're doing some on time, not just being in your business selling, to educate yourself on the why behind rates and the why behind the market right now. We've gotten a little reprieve the last several weeks and the last really couple of months back to June, as Trump, who is, if people haven't figured out yet whether you like him or not, whether you like his tweets or not, I mean, for the first time in 100 years, we have a guy who's our president who had a freaking job before he took the presidency. And he really ran
no kidding.
it's the truth. And he ran a business, and he's a numbers guy. And I heard somebody the other day on one of the big networks, I think it was Fox, but he said it was such a powerful thought that's going to tie to what I'm going to say on these rates. He said, what people don't get is Trump's the first president of Republican or Democrat in our lifetime that actually asks questions about the numbers. Like he saw $800 billion trade deficit with China and went, hey, that's not fair. That's real. No, we're going to get some of that back. So he's this negotiator.
Got to address
it. When he started doing the trade thing here a couple months ago, whacked the stock market for a minute, and it came back, and then it stalled the rate rise. Rates had poked above. Let's go to the 10-year Treasury. U.S. Treasuries don't exactly equal mortgage rates every day, but they tend to travel in the same direction over time. And when the 10-year Treasury moved above 3, it got up to 3.08 back in June. It was like, oh, Katie bar the door. I did a recording to our people and just said, if this breaks through and 3 becomes the floor as we go into this 4% second quarter growth, which I was buying that's what it was going to be, and it turned out to be right. I was preparing our people that watch out. We haven't had one of those days, Jay, in over a decade where the bond market sells off limit in 30 seconds or less.
Right.
I've been around. It's happened 4 times in my 32-year career. I can name the dates. And it's a really, really funny feeling when you, when you're like, you told your client the day before, yeah, let's wait till tomorrow, may trade be off an 1/8, and you're calling your client to go, hey, 5.5, 4 3/4, it's all deductible, right? That's a tougher call when rates move, 300 basis points in a minute. And that day's coming, I'm telling you, because when wage inflation and some of these things click, back to that guy who's working for Goldman Sachs in London, when he checks all his buddies and everybody hits the sell button at the same time because they all of a sudden see wage inflation is up, 2.5%, and the PCE is a little hot at 2.7 instead of 1.9 like it was 2 months ago. That's where you'll see those rates do that shift, and I think it'll happen sometime in the next year. And again, we're not going to 10% or anything. I just think rates are going to move into the 5s next year. They've already tested it. There's a phenomenon, and you mentioned my good friend Barry Habib. A lot of people use Barry, and he's done so much in the industry, and we did a lot of cool things together in our years. But from mortgage market guys days to MBS Highway, I'll give them both plugs. You need to be in some kind of model like that where you're educating yourself and listening and learning, because there's a why to this market stuff, and it's a free market. So just like the 10-year yield poked 3 in June, and then it pulled back and kind of rested back all the way down to the 276, 282, and then now it's back to 294 yesterday, 296, and then today popped above 3 on a Fed day, because the reality is, even though it retrenched with the trade stuff and that could maybe cool the economy, the reality of this economy is moving forward. The part that's so amazing, and I love talking about this economic stuff, it's one of my real passions, but I call it the Amazon economy. The same phenomenon, what I'm talking about. That you can literally, right now, while we're both talking, we could both pop on Amazon Prime, realize that we need, a bottle of Tide and hit our button if we're Prime members, and it's on our doorstep in the morning, with no extra fee. That's a phenomenon that I can't get my arms around yet, Jay, and that's why we don't have, inflation is there, but it's still so tame. It's still within the Fed's range. Oil prices are obviously in the 70s. The economy's been able to absorb that and not be passed along to the consumer that much at the pump. I don't see that honestly going much higher, because the U.S. is pretty much energy dependent for the first time ever. And that's an amazing phenomenon that we'll see what happens in the future with green energy and all that. But we still have a 4% growing economy. And I think wage inflation will come eventually. I see rates, in the 5s again by next year. All that to say, margin compression has happened. Probably the worst of it's behind us, but it's still going to continue as rates rise. And that's what it means when you look at the fact of squeeze on profits for the lender, got to do more with less income. We prepared ahead of time, and I think others out there did too. We have built a closing system, for example, that just screams with efficiency. We have a process that we teach. So that's what I would challenge, lenders, individual loan officers, branch managers, owners, to make sure you've done the old Zig Ziglar line of check up from the neck up in every area of your company. I know we're going to get into that in a minute, but
well, let me ask you one thing on that, because you hit it. So I'll kind of reframe the question, and and let you speak on this for maybe a minute or two. You talked about, MBS Highway and equipping yourself. And you're right on that. So let's imagine, I know, probably a third of the people that are listening today are real estate agents who are not, they're not down in the trenches nearly as much as what you and I are. And also too, I mean, there's a heck of a lot of loan officers that, because they haven't had to deal with this that much, if at all, in the last 10 years, they're not experts on it. So take a minute or two and just outline for that person who, man, they just haven't been studying that much. They really don't know. They need to educate themselves. What are 2 or 3 practical steps they need to take? Because I know this is a huge part of your success when you were originator, being that educator. What should they do?
Yeah. Okay. If you want to be educated, I always used to teach the couple of simple things to watch every month, because they happen every month. Unemployment numbers, big deal. In this economy, in the past almost 2 years, Trump economy as we'll call it, there's been a ton of jobs created. We're way back up. Unemployment's way down. Every area of the economy. There's actually more jobs right now, LinkedIn says, in the United States available than there are people for the first time ever in our history. So when you get jobs in that situation, usually there's what's called wage inflation that follows. All of a sudden, like the last time we had really big wage inflation was in the internet bubble back in 2000, where, all of a sudden somebody was offering somebody over here, 20 grand more to do the same job, or signing bonuses or stock options, and wage inflation sparked and rates rose at the same time. Right now, the Fed is ahead of the curve, I think, pretty well. Inflation's under control, but the economy is very, very strong. So if someone wanted to educate themselves, look at the unemployment number. It comes out the first Friday of every month. And then there's a weekly unemployment number too. Today, that number came out. It was like 17 or 18,000 above what the expectation was. So again, it continues to show strong job growth. If you want to get real detailed, there's a thing called the participation rate. The participation rate is back to as high as it's been in over 20 years. Lots of people have come back into the job market because there's good jobs again. And so all those things usually point to wage inflation eventually, which pushes rates higher. Now, granted, rates are higher, right? We just said they're 150 basis points roughly higher at their peak than they were the week before the election in 2016. So the rates have already moved up. The Fed is doing a good job of keeping us ahead of the curve as the term goes, but watching what jobs are doing monthly, watching a thing called the personal consumption expenditure, the PCE index, is the main leading measurement of consumer inflation that the Federal Reserve looks at every month. What I always used to teach loan officers and consumers on this stuff, Jay, is the Fed's a bunch of really smart people, but they don't know, like you and I don't know until they get the numbers, and they maybe get them a day before us, what's really going to happen. So they're constantly diving over those numbers. They're looking at this stuff, and they've made really good decisions so far in tightening. That graph I sent you today by email that came out of our internal stuff, it just shows from January 1st, it jumps back to this year, then it shows June 29th, and it shows the other day on the last day of July, or July 29th, 2 days ago. And it just shows how the yield curve is flattened a bit in the middle, because we haven't seen inflation. The Fed has kind of predicted, and others too, that we'd see more wage inflation by now. But again, I blame that in a good way on this Amazon economy and the efficiencies of the marketplace. And, Apple yesterday's earnings were insane. They're about to become the first, $1 trillion net worth company in the history of the world, I guess. And with what their stock is this morning at 203 or 204 bucks a share. And it's just amazing the efficiencies that continue to pour in this economy that do keep rates low. And my point there for everyone is, loan officers, listen to me. Realtors, listen to me. Say it out loud in the mirror. Mr. and Mrs. Smith, 5.5% is a great rate. Just practice that.
You bet.
Because, to say, oh, gee, even though I really want to talk about something important. I told my daughter, in fact, yesterday, she's a loan officer for us. I'm coaching her right now. And, it's, yes, rates are going up a little bit, but I can remember like yesterday, my grandfather, who lived to be 103 and was one of my greatest mentors for years in my career, would always say, well, you're never going to see 5 3/8 like I had back in the 50s. Ha ha ha, right? Because a lot of people in the generation I just talked about that got in this business in 08 and 09 don't even know what a 5 3/8 rate is yet. We're about to see it. But yet, if you look at the reality of rates, obviously, if you still look back at the 30-year average, you're talking about like 6.8, 6.9% over 30 years is the average, and rates are just phenomenal right now in this marketplace. But a really cool point to know for realtors and listeners, when you think, well, gosh, the last year my borrowers barely qualified when they were in the fours. Here's what's beginning to happen, and when you see wage inflation start to kick in. I told my daughter this yesterday. I've seen this now, and this is my 5th good cycle in 32 years, Jay, and it happens the same every single time. You take a couple that, let's say, bought their house 3 years ago, and I'm just going to pick out, anybody in the USA in any state, and here's this guy that works, let's say, for IBM, and he's a engineer, and he's making, $90,000 a year, and he gets a small bonus, say $10,000, which makes him $100,000. Now, let's say mom, the typical family, was working for AT&T, and then she ended up taking this part-time job because the kids hit the ground, and they got 2 or 3 kids, but she's got this cool job where she can work somewhat virtual, and she's making 45, and combined with this $145,000 income family, and they bought this, house for $220 back in 2012. You with me? Okay, so now today things are rocking, and I'm just picked those 2 companies I just picked, IBM and AT&T. I just randomly made that up, but this is true. So now this guy is getting, all of a sudden, IBM's going, hey, we're blowing and going. You've been great. We need you to move up into this new slot because the guy above you moved up, and this new job has this opportunity, and your 90 base just went to 130, and you're eligible for a 20K bonus. So you're a 150 guy now. And then AT&T calls up and says, hey, Betty Lou, man, thank you for your service. Thanks for doing this so well. With technology the way things are today, we want you to be full-time and be virtual and still stay with the kids. And when you come in, my older daughter just took a new job, and she has a new baby. And it's so amazing to me. They've even got, because she's a brand new mama, she had a baby June 13th, my first grandchild. They've got this nursing room where you can go do, I'm just going to be straight up, breast pump, and they'll ship the stuff for you to a freezer service it's amazing where companies are in their realities of serving, working women and men and families. And so this stuff is happening. So now this stay-at-home mom who was doing part-time with AT&T is about to get this gig that instead of 45, she's going to make 70, and she's going to still get to be home 70% of the time and take care of her new baby and have all these services that the company offers her to be in that role as mom and hardworking executive. But do the math. The 2 of them just went from 145 in the last 18 months to, let's add up what I just said, the 150 plus the 70 plus she gets a $10,000 bonus. So all of a sudden they're a $330,000 couple. Guess what? Babies are getting older. They both go, 220 house in 2012 is now worth 290. So we got 70K more equity, and who cares if rates are 5.5? We're making 330, and we want to go buy this 481. It's bigger, or this 5.
And that's a call to action, Jim. That's a call to action for those that are listening, loan officers in particular, but agents as well. What a great opportunity to go to your database of your past clients and start paying attention to, where are they working? What was the home price when you did that loan form 4 years ago? And take a look and be proactive. I mean, I'm always, we want to have a great reason to reach out and touch a past client. And what you're talking about right here, it is.
It's huge, because this is the shift that you're seeing, and we're already seeing it. We're doing, like I said, we're up 24% year over year in volume. We've grown in the strategic areas. The Houston market, our Texas markets are just incredible. This Dallas market with the Toyota move of the North American headquarters for Toyotas right down the street from our office, the new FedEx North American headquarters, thousands and thousands of jobs, and they're great paying jobs. And this is happening all over the country in certain sectors. South Carolina is booming, North Carolina, all these different places. And that's what you've got to look at is get away from it. Loan officers got to get over the guilt of, oh, gee, I can't get you 3 3/4 anymore. 3 3/4 was a false rate. Let me just tell you, the U.S. Treasury and the Federal Reserve, not the U.S. Treasury, the Federal Reserve, if you just jump back to 2005 and 2006, had $200 million on their balance sheet. Okay, that's like me and you having $50 in our checking account. Today, the Federal Reserve, because they had been trying to stimulate this economy through the worst recession close to the Great Depression in the history of our country, they got $4 trillion plus on their balance sheet. And so all that stuff's got a cost to it too in the future. But they've been trying to stimulate and inflate this economy. The Fed has been trying to create inflation for 8 years, 8 of the last 10 years.
Yep.
And we're finally got traction. This economy's growing. We've wiped out a ton of regulations. We're energy independent. There's all this stuff happening. So what I just told you is happening right now. Wages are going up. They are starting to rise. They're rising at about just under 2% right now. That's probably going to pop above 2% over the next 12 months. That'll be a little bit of seen as wage inflation. Rates will move up like they already have, but they'll probably move up a little more. I can see, mid fives, low fives, mid fives next year. Rates bouncing around in between that. But and yeah, we'll have another recession in a couple of years. That always cycles. And you refinance those people, we'll get back in the fours. But it's a great economy right now. The chaos side of the message of the markets, if you will study and understand, you can build a database and become a valued treasure right now to your realtors and to your consumer. That's just unbelievable. And that's what I did back from the RTC Resolution Trust days and the S&L crisis of 89 to 92, and the Russian ruble crisis in 98, and the tech crash of 99 to 2002. All those markets, I killed it because I was there to explain why. Here's what's happening.
Well, I remember one of my first conversations with Todd Duncan. He shared a story about, I think it was maybe his second year in the business, something like that, and I believe he said he wore a little button that said, rates are at 16%. Ask me how I can help you, or something like that. And looking at it as an opportunity, right?
Yep. January of 1982, 30-year fixed rates were 18.6%. That's the highest that true 30-year fixed ever were sold in this country. The prime rate was like at 20 for a short time. But, and again, a lot of people hear old dogs like us say that. I was in college at the time, but, then Reagan came in and the rest of the world changed. But, the rates are phenomenal, and wages are rising. The economy is doing good, and that's what you have to understand. That's a good news phenomenon. Now, when things are good, like they were the last 4 or 5 years, Jay, way too many people get in our business, way too many people get in the real estate business, and you have to wade through a lot of mediocrity. But the magic is making the choice to improve you and to educate yourself and to become that more valuable resource, and have a valuable message. And that's for realtors. I would just challenge you to make sure you have got a true lending partner and an alliance. My best relationships over the years were one-on-one. Certainly the realtor might say, hey, you can use whoever you want, or I can give you other names. But the reason I use Jim McMahan is because his presentation is amazing on fiscal literacy. In other words, they scripted the words because I was helping clients on, acquisition debt, all the things. With the state of Texas, we have this goofy homestead law. I had my realtors always explain to people, hey, we used to be a country, 6 flags over Texas. You need to hear Jim's presentation to understand our homestead laws are so weird in Texas. We're the last state out of 50 to get home equity lending laws, and ours are very strict. So it's back to what is your value proposition. And if you don't really have one other than I'm an honest person and I know the rules and guidelines, it's okay. The problem is so does everybody else pretty much that's out there doing this for a living, and you need to up your game right now. But it's a fun time to do it because more than ever, people really want to deal with people who know what they're talking about. People want to be led by great advice and great information, and they'll pay for it, by the way, gladly. To show someone to take a slightly higher rate and have a lender paid MI and pay off your truck and use that extra money to fund a college education or to pay down the second lien, or get complicated to get the best result for your client. And that means you have to educate yourself. I'm not saying get complicated to fool somebody. I'm saying that there's some amazing things that can be done today if you'll sharpen your sword and look at all your choices in your lending, quiver of arrows.
Well, absolutely. One quick thing I would say is when you're operating like that, you can be you. There's no selling. You're educating people. You're looking out for their best interests. And man, that comes through. It's so obvious to people, both when you're trying to quote unquote sell them or when you are truly out for them to help them. And that's so attractive. Couple quick things, and then I want to ask you, because I know you and we could talk all day. So I want to hit a couple things before we go. One, I would say to our listeners, some of the information that Jim touched on, we will make sure and provide some links and follow-up information, especially for real estate agents. We'll try to get you some resources that will aid you in that. So maybe let's do this, Jim. You mentioned that you had some of your top producers in last week, I think you said. Mm-hmm. And so maybe there were some things that were shared there. I'm sure there are. But I wanted to ask you, for those that are listening, we'll make this specific to loan officers. Maybe share a couple principles, best practices, maybe 2 or 3 that you feel like the loan officers listening today, man, you've got to implement this if you really want to grow the next 12 months. What are you sharing with your people?
The biggest thing that we did at this mastermind was talk about truly a consultative borrower presentation, slowing down and making sure that a referral partner, being a realtor, values the reality of not just quoting a rate and fees. That borders on stupidity right now in this marketplace because it's almost meaningless if you don't have it is meaningless if you don't have a contract in hand. Because look how fast rates are moving around. I mean, they're up a quarter, down a quarter, up an eighth, down an eighth, and then you can add another eighth to a quarter to that just off of somebody's FICO score if they're doing a government loan or VA loan or conventional. So, doing a true consultative borrower presentation where you make that your filter of who you do business with, and you fill that with value and truth on what it means to be qualified, what it means to be pre-qualified, getting clear on the things you have to do to be the best borrower you can be in a tough marketplace right now where we got an office in Grand Rapids, Michigan, where talking to one of our guys up there the other day, he ended up finding out he wrote 3 pre-approval letters a couple weekends ago for 3 borrowers on the same property, and on that property there was 34 offers. He was 3 of the 34. So that stuff's still out there too. And so having a consultative presentation today where you become the filter. So Jay calls me up and says, "Hey Jim, got referred to you by Betty Sue at Remax. They just want to get your rate and fees. Heard you're a good guy." I'm going to say, Jay, I appreciate that. And I know Betty Sue well. She's one of the best out there. But I just want to tell you, just to quote a rate and fee over the phone when you haven't got a property yet is meaningless. I can tell you that rates have been traveling in a range. That may snap me like a snap of a 30-day chart or something off a Mortgage Market Guide or MBS Highway. But Jay, rates have been traveling in a range with as high as 5 1/8, 5 1/4 over the last 120 days to as low as 4 5/8. And then besides being in that half a point range, you could add another quarter, take off another quarter based on FICO score and several other things. So to really give you an accurate forecast and best rate strategy, I need to sit down with you, or if we're not in the same city, I want to schedule a webinar to walk you through my best practice borrower presentation. That's what we focused our whole day and a half on, our top people in. Because only then, and then the people, I'm just, you know what? Okay, that's how we do business, Jay. And I can tell you.
Absolutely. Yeah, those aren't the people you want to do business with anyway.
Exactly. Because if someone is not going to value my time, then I've got so much knowledge to give you. And I can explain to you the why behind the Federal Reserve and what they're doing today. I can interpret their minutes they're going to put out this afternoon. I can, that's valuable. And I want my realtors to understand, in my $100 million years, I was down to a core 8. And, the people, Mary Harker, who's one of my best friends, and Joe, her husband, Keller Williams owners today, and she was #1 Remax 6 out of the 10 years in the 90s. I was their exclusive lender, and they certainly would offer someone other names, but they realized the value I could bring, and several others like them. It was exclusive because we both had the best practice ideology for the borrower in the end result. And so I would be honing in the best borrower presentation that can be had today. It's a 30 to 40 minute quality time presentation to get into the why behind what's most important to a mortgage with them, because there are different choices out there, right? If it's a reload person, they got 2 points or a point being paid, and they know they're out of here in 5 years, and it's, depending on the loan size, maybe they're going to look at a 5 or 7 year arm today. The yield curve's still kind of flat, but there's some spread there with points. Or even, with this margin compression thing, one last thing I'll say on that, because of margin compression, some days there's not really a true par price, and loan officers get so confused that have been in the business 10 years or less. Well, go run that deal with a point in the deal. All of a sudden, there's days where usually a point buys a quarter in rate. There's days where a point might buy 3/8 to a half on these
absolutely
compression days. And if you're not paying attention to that, shame on you. And then coaching.
That's malpractice. It's malpractice to not pay attention like that.
Coach the realtors that are listening. You write a contract, and you can't go back and do shenanigans in the contract. But if up front you're already being coached by a great loan officer that, hey, if we can build a point into this contract and buy this rate down for this buyer, you got a done deal here, and the buyer wins with a 3/8 lower rate, which is usually an 1/8 to a quarter lower rate, and now everybody comes in with the price right and the contract written right. That's great advice, and that gets deals done and helps the borrower win. So those are the kind of things I'm talking about. And I'll finish this thought with this, Jay. You need to premeditate your advice before you sit down with a client. Just like there's not a doctor that goes in and goes, yeah, I'm doing this lung transplant, and I think I know what I'm going to do, and I'm probably just going to kind of wing left and then come back right. No, I mean, gosh, they practice on cadavers for years. So you better practice this and premeditate it, so that you really have practiced and you can show somebody and you know that you know.
Yeah. Well, I'm gonna want to mention one thing quick. We'll jump to the last question, but I remember this was probably, I don't know, 6, 8, 10 years ago maybe, but and I think it was actually the first time I listened to you speak, and you were talking to real estate agents, and you were talking about how, I think it was specific to loan officers, that there's enough people out there that are willing to do business your way. My way.
Not to worry about those who will not.
Those that don't, man, we're moving on. And so this right here, I just love that. I mean, I think that ties in with a fundamental philosophy you've always had. If someone's not willing to do business your way, moving on. We're going to go find somebody else. And I mean, I would say that is there's 2 or 3 common denominators with the guys and gals that are producing at the very, very top, and that is one of them. Not going to waste time, not going to, cry myself to sleep. If there's somebody out there that doesn't want to work with me, I want to work with the best of the best. And there's more than enough out there that are willing to do business my way. It was just one of my favorite quotes that you shared.
Thank you. And, I swiped that from Jim Rohn years ago, like way back. I was in my first seminar I ever went to his in college in 1982. But, Rohn said, there are enough people that will do business my way. I need not worry about those who will not. But the magic of the quote is the my way, those 2 words. And for the listeners, you have to understand, realtors and loan officers, the more you work on your defining, unique selling proposition, USP, your way of doing business, that differentiates you and that has a taste and a feel and a smell, because so often, like I said that thousands of times, Jay, in all the hundreds of seminars I did, and everybody always wanted to write it down. Oh, slow down, say that again. Oh, that's so good. Gosh, I love that. No one disagreed with that quote ever. But the problem with it is that so often people did business the industry's way and followed it more often than defining their own way or some, defining way that's, because the industry's way is at the core of all of us. I mean, as far as we're dealing with, a mortgage product and all that kind of stuff, but your unique selling proposition, your expertise becomes your way, which becomes marketable and valuable, and people will line up to get it.
Well, again, you can just be you. When it's my way, I can be me. I don't have to pretend to be somebody else. I don't have to sell you. It's genuine. I'm transparent. I can be honest. And again, that's just so attractive. So I can't agree with you on that anymore. So hey, we're gonna have to wrap. I could talk to you, like I said, I could talk to you for a couple hours. There's no doubt about it. And I think everything you've shared has been super valuable. Before we go, maybe anything else you want to share with those that are listening? Maybe something I haven't had a chance to ask you about, kind of touch on yet.
2 parts, and just wrapping up. One, maybe we can do another call sometime on just the changing technology and out there in the industry today.
Yes.
Just make sure you've assessed your process. I mean, are you using everything to make efficiencies from, with our model, Encompass and then Flowify, and, we still use day one certainty, but more than anything, we've learned how to just, with online application and uploading docs and making ease and efficiency for the buyer. I mean, we're doing 9-day closings, 10-day closings, 14-day closings all over the country. My company will do just over $3 billion this year. We just did our third $300 million month in a row. For us, that's big numbers, 3 record months in a row in our 19-year history. But so assessing your process. But then the last thing I think, in closing, just something that impacts people, assess you. As a professional in this industry, realtor and loan officer, I think one of the biggest assessments you can do is first a reality and then an assessment. The reality is the spoken word. The power of what you say, which you're already saying words to people, but is powerful. The tongue is a creative force and a powerful force. It can paint like a Picasso and make someone feel great about themselves. It can crush people, with the wrong words. So with that said, assess you and assess what do I say in critical selling situations? What should I say that is, even like you heard me say a minute ago, setting up to say, Jay, I want to spend 30 to 45 quality minutes with you where I can really help you understand that I'm not just a regular loan officer, but I see myself differently. I want to weave your mortgage into your long and short-term overall financial plan so that we can truly create the lowest cost loan over time. That may be a rate that's slightly higher with a different MI structure. So those are powerful words, right? I have practiced that.
Well, I would imagine what you just rattled off right there. I know you talk, you're able to go off the cuff. But my guess would be the phrasing you just used there. That's probably scripting that you've used your entire career when letting people know who you are. Am I right?
Right, and that's the point, is practicing. I had that product, Jim McMahan Certified Scripts, for years and years with thousands of subscribers, and then merged it with Barry and MMG. And it's my heart to say words that matter and that make a difference so that people can shift towards a great decision that has a great outcome for them. And so that'd be my takeaway is assess you. And the biggest assessment is reassessing, what do I say? And am I managing my words to effectively create the outcome that's best for my customer?
You bet. When you do that, you take care of your customer, things take care of itself. You don't have to you're not selling. You'll close more loans than you can imagine, or sell more homes than you could ever believe. So, Jim, friend, hey man, thank you so much for stopping in, chatting for a little bit. I know those that are listening are going to find a ton of use with the information that you shared, and I just always enjoy getting to catch up with you.
Well, thanks, Jay. Appreciate all you do for others and for the industry, man. It's fun. Thank you.
Yeah, you bet. All right. Well, hey, those that are still on the call, thank you for listening. And again, this is Jay Hughes with Press On, helping you close more loans in less time.